gentlemen, in a phase where equity market is on a firing spree, long-short space has been quietly making a steady journey. Long-short equity AIFs do not get carried away by market euphoria and maintain the discipline of extracting alpha from the market on both sides by maintaining long as well as short bets in the portfolio. Does this really bring in outperformance on risk-adjusted basis? And how do various long-short strategies hedge their portfolios and actually cut the market risk? To shed light on this new space of alternative investment funds, which are becoming popular to accredited high net worth investors who like to invest with the lens of adjusted lens returns, ladies and gentlemen, we've got for you our next session. And the theme of this next session is, do challenges of overvalued and uncertain markets throw up the biggest opportunity for long-short investments? The esteemed panelists for this discussion are Mr. Harsh Agarwal, Mr. Nalin Moniz, and Mr. Rajesh Bhatia, and Mr. Bhautik Ambani will be moderating this chat. Let me take a moment to introduce our esteemed panelists to you. Mr. Harsh Agarwal heads the alternative strategies at Tata AMC. He has more than 18 years of experience in equity portfolio management as well as research. He joined Tata Asset Management in November 2018 as head of alternative strategies and launched the maiden hedge fund from the House of Tatas. Prior to joining Tata Asset Management, he worked largely in hedge fund setups and proprietary trading firms. He started his career by managing family investments and shortly moved on to providing equity research and advisory to Equitech, a long-short equity proprietary trading desk of Deutsche Bank. He's an MBA in finance from Symbiosis, Pune. We have with us Mr. Nalin Moniz, who is a graduate of the Jerome Fisher Program in Management and Technology from the University of Pennsylvania, USA, with joint degrees in economics from the Wharton School and computer science engineering from the Moore School. He was earlier associated with Goldman Sachs Asset Management as a portfolio manager when he thought of starting his own venture in India by the name of Forefront Capital Management, an alternative asset management firm, which was acquired by Edelweiss in 2014. Now, with a decade and a half of financial experience under his belt, he played a pivotal role in Edelweiss's acquisition of Ambit Capital's AIF business in 2016. And at Edelweiss Asset Management, he leads the research and portfolio management for the alternative equity funds across AIF, PMS, and offshore platforms, in addition to being the fund manager for the Edelweiss Alternative Equity Scheme. Now we have with us Mr. Rajesh Bhatia, ladies and gentlemen, who is the MD and CIO at the Investment Trust of India Long Short Equity Fund. He has over 30 years of investment experience in Indian equities, of which the last 14 years have been in alternative investments, long-short fund management, and prior to ITI, he was the CIO Simto Investments, a subsidiary of Tata Investments. He has been the co-founder and CIO Heritage India Advisors, Indian advisor to New York-based Heritage Capital, an India long-short equity fund. He's a commerce graduate, HR College of Commerce and Economics, and ACMA, Cost and Management Accounting, and has completed the CFA program conducted by CFA Institute, USA. This session, ladies and gentlemen, will be moderated by Mr. Bhautik Ambani, who is the Executive Director of Avendus Capital Public Markets Alternate Strategies, LLP. He joined Avendus in December 2016, and prior to joining Avendus, Mr. Ambani was the Director of Ambit Investment Advisors, where he was responsible for marketing of the Ambit Alpha Fund, which was one of the largest hedge funds in India. He spent the last 15 years in the asset management and wealth management industry in India, and he's an MBA in finance from SP Jain Institute of Management. And ladies and gentlemen, with that, I extend a very, very warm welcome to our eminent panelists and hand over the proceedings to our moderator, Mr. Bhautik Ambani. Sir, all yours.
Thank you. Thank you, Aishwarya. Thank you to all the investors or the prospects who have joined us on this call today. And thank you, PMCIF World, for having this session. So I think our primary objective today, and I'm going to wear a slightly different hat today, looking at it from the investor's lens, rather than looking at it from the other side when I'm usually telling them why they should invest in long short funds. But I think that's the job that Nalin, Rajesh, and Harsh are going to do today, that why long short funds kind of make sense for investors. Just before that, we're in very interesting times in the market. Markets have been fairly topsy-turvy in the last 6 months. They've just been in the range of around 16,000 to 18,000 market levels. Last couple of years have been very good, and that's exactly the reason why none of us are complaining about the markets at all, because we've made very good returns. considering where we are today, where everyone's talking about high inflation numbers, I'm sure people are reading headlines of 7.5% inflation in the US, which is like high over a very, very long period of time, a multi-decadal high. People are talking about interest rates going up and what's going to happen to the equity markets going forward. And for most people, I think the view is that 2022 might not be as easy as what we've had in 2020 and 2021. And considering this current market environment, all of us want to know why long short funds or such alternate investments make sense, or what is the importance of having them in a client portfolio. So I think what we should do is maybe just go across the table, Nalin, Rajesh, Harsh, if you all can let us know why you think long short funds kind of make sense in a client's portfolio and what's the importance of them. Nalin, you want to go ahead?
Thanks, Bautik. I think there is one very, very practical reason for why long short funds make sense. All of us in the audience and on this call appreciate and understand the power of compounding in equities and the growth that India has to offer in the coming years. But it's never a smooth ride. It's often a roller coaster, and investors have a hard time holding on and finally experiencing that compounding journey. Long short funds, by smoothing out that experience, make it easier for an investor to stay invested. And also, if you remember Buffett's first rule, it's don't lose money. The second rule is don't forget rule number 1. Lowering volatility is often thought of as reducing return. But actually what a lot of long short funds have demonstrated over the last decade, Bautik, is that lowering volatility can actually help you to compound at a higher rate than if you had, the typical wild swings that you see in equity markets. So that is a very, very compelling reason for an investor to look at the long short category. Thanks, Bautik.
That's interesting. So basically the power from compounding, but with low volatility, which basically what you're trying to say is that compounding will improve if your volatility is lower, right? So that's a very interesting way of looking at it, why long short funds make sense compared to, let's say, some of the other traditional asset classes. Rajesh, what's your sense?
Yeah, I think let me contextualize what Nalin just kind of pointed out. When we talk to investors today, what they seem to be telling us is that they are not making a return on fixed income. The yields on fixed income on a real basis have been negative since the last 3 years or so. And, when they look at equity markets today, especially, they recognize that there is a lot of excessive enthusiasm. And the primary reason why these equity markets have done as well as they have done is because of this unleashing of large amounts of monetary stimulus, which is unprecedented in the history of mankind, right? At one point of time, there was 16 or 18 trillion dollars of bonds, which were at negative yields. So clearly, this is an artificially engineered, asset across asset class market. And therefore, they feel very apprehensive that now that there is an implication of this large stimulus in the name of inflation, as you pointed out, that there is going to be a reversal of this policy of some sorts. We don't know the intensity, but certainly I think the direction is fairly clear. Given that context, that what led the entire primary trend, which is this stimulus, is getting reversed, they are looking for risk-adjusted returns, and they clearly are very extremely worried about participating in equity at elevated levels. So, how do you navigate such an environment where I'm not making money in fixed income, but the equity class is susceptible to large volatility now, given where this is? And in fact, our view is that this is not going to be a genie that can be very easily put back into the bottle. And therefore, this kind of volatility is going to continue, as we move forward as well. So as Nalin pointed out, the job of a long short equity fund is to offer asymmetric return, which is when markets fall, because of the ability to short and change equity allocations, you can protect the downside, and at the same time, tactically, you can navigate the market on the upside as well and participate on the upside. So that is the advantage and the flexibility that a long short brings to the table, and even more, this is resonating with clients today, HNIs today.
That's interesting, Rajesh. So, another perspective to volatility and, what kind of environment we are in with fixed income yields, volatility in the equity markets. So that's an interesting way of looking at, long short funds and how they can offer asymmetric returns.
By the way, Bautik, this is not only an Indian phenomenon, this is a global phenomenon. And, so migration to hedge funds, macro-driven hedge funds particularly, is not only, it's also, something that the international investors are doing. By the way, this is a $4 trillion market globally. So it's a huge market. And as far as India is concerned, we're just taking baby steps. So the opportunity is very large. And I think investors are adapting to this new asset class.
So actually, we would like to discuss a little more on that, how the trend has been globally versus, how it is shaped up in India. But just before that, let me just get Harsh's initial views on, what are his thoughts around the importance of long short funds, that he sees from a client perspective.
Yeah, thanks, Bautik, for that. So, when you're looking from client's perspective, clients are looking at either equity investments or fixed income. Nalin, I think, explained very well why it makes sense for investors to look at long short funds when they're looking at equities per se, because it reduces your volatility and hence your compounding becomes better. Your journey is smoother. But it's not just with respect to equities that you have to see long short funds. You should also see with respect to fixed income. So, when you're talking about long short funds, they could be designed in a fixed income plus manner. So you'll say your fixed income today gives about 6%. Your long short funds, which are fixed income oriented, they can give you about 12%. So you'll have a whole lot of opportunities and offerings from long short funds, which are like fixed income plus, or they are, reducing volatility on the equity side, but giving you either similar returns or even better returns over a, long-term time frame. So that's the key advantage. It has to become a superior offering relative to what the conventional assets offer.
Interesting, Harsh. So, I just want to kind of jump back to, something that Rajesh was mentioning around how hedge funds is a large industry globally, right? Around $4 trillion. In India, we've seen, this industry only grow over the last 8 to 10 years. Obviously, in the last 2 to 3 years, we've seen many more funds coming into this space, which has made this category much more interesting. I just want to get some sense from Nalin and from Rajesh, considering you've seen how funds are structured globally. You've worked internationally as well, not just in India. Considering the multi-decadal experience that you have, what's your sense? How is the long short fund journey has been globally? And sometimes we do get a sense of how it is shaped up globally. Maybe we'll have a similar path in India as well going forward. So Nalin, Rajesh, let's get your perspective on that.
Right, Bautik. So India is very early in her journey in this asset class. The Cat 3 AIF industry is only about a decade old. But in contrast, globally, the hedge fund industry is almost 60, 70 years old. And it has been a sizable asset class for the better part of 40 years. Hedge funds are at about 3 to 4 trillion, dollars in AUM, and about a quarter of that is in equity long short. So over $1 trillion, Bautik, is in equity long short. One of the key trends that is happening globally and will also happen in India at some point is a separation of low cost beta and then high cost alpha or skill. And what this means is that an equity investor may look to have index funds or ETFs at the core of their portfolio. at very low cost, and then, hedge funds or long short funds in their satellite part of their allocation to add that outperformance. It's still very, very early days. It's super exciting. The industry is being built one brick at a time. And I'm actually very happy that we have, I think, a core group of maybe 15 to 20 really credible managers and AMCs who have taken this first step in the long short space. So I couldn't be more excited about what the future has to hold. Rajesh?
Yeah, so the genesis of the long short equity space was is as documented is by Alfred Jones, and his idea was that if I'm long X dollars of a certain stock that I like on the long side, and if I'm short a similar X dollar on the short side, which I don't like, what I have done is, if my net equity exposure becomes zero, and I have reduced therefore my beta and enhanced my alpha. That is the genesis of how this whole thing started. I think, as Nalin pointed out, this is a large industry globally, and even now evolving. As far as India is concerned, I think the requirement, is more that we need to create history of the product. The longer history that you create of this product and the more participants you have on the long short asset class, I am confident that once they know what to expect based on what has been in terms of the past track record, I think this asset class is going to rise dramatically. One thing you can bet is that this is going to go multiple times from where we are. So this asset class clearly is adding value. I think Nalin put it extremely correctly that as you move forward, and that's a trend that you're seeing globally as well, if you don't add value, people are going to ETFs, right? Or they will want to look for products which can add value. So I think long short clearly is one of the spaces that would be coveted in that sense.
That's a very good perspective from both Nalin and Rajesh in terms of how long short funds are adding value to a client's portfolio, and going forward, more and more investors are looking at not paying so much for beta, and that's exactly the reason why we've seen this trend in India as well, where ETFs, index funds are becoming a much bigger part of the portfolio. That brings me actually to a very interesting point. We've all been talking to a lot of wealth managers over the last 8 to 10 years since the time long short funds have come into the industry. People have allocated, have started allocating more compared to what they've done in the past. But having said that, in our experience, right, when we are dealing with so many of these wealth managers, what is your experience? Why do you think that they're still not allocating a larger portion of a client's portfolio into long short funds compared to what they should be actually doing or what it is globally? Right. So there is some kind of apprehension there. What would be your message to some of these wealth managers? How could you kind of convince them to allocate a higher portion to long short funds? Harsh, you want to talk about that?
Sure. So I think the wealth managers they have to look at the long short products more closely. So while there are, let's say, 10 long short funds in India, they all are very different. So somehow investors think that they all are similar, but first thing is to understand that all the long short funds are different and they are meeting a different need for the investor. So once once the wealth managers and investors see the long short funds in this light, I think they will understand what need each individual long short fund is really meeting. So that is one. Second is I think they also need to appreciate that the long short funds, how much alpha they are making on the risk basis. So a lot of long short funds, they will not look as great when the markets are rising up because they always have lower volatility and hence they have a more, let's say, range bounded outcome to them. So in a euphoric market, let's say when Nifty goes up 70%, your long short funds will be much lower, and understandably so. And when the markets are falling or crashing 20% or 30%, then long shorts, they hold the ground. They don't fall as much, or they don't even fall at all. And some of them actually even benefit and rise with the falling markets. So I think as the conventional assets, be it fixed income or equities, their returns normalize to, let's say, for equities, it normalizes to about 10% or 12% or so. I think that's when the long shorts, will come more into limelight, when it will become more obvious, that the kind of alpha they are generating, while the risks are obviously much lower. So I think with time, the understanding of this category will improve. With time, the funds would have increased, their track records as well, and people will understand that there is a difference between each of the long short funds, and they will accordingly be able to choose the right one which suits them better.
Okay, that's. I'm hoping that we see more of that from some of our partners who are wealth managers, advisors. Rajesh, you have any additional thoughts to what Harsh just mentioned?
So I think one of the apprehensions could be that this is a discretionary product, right? So if you look at a long only product, how much can a long only manager go wrong? I mean, at the extreme, they are hugging the index, right? And they are not taking usually cash calls. Whereas you need to bring serious talent to managing a long short equity fund. But I think people must appreciate that there is a great degree of specialization in what long short fund managers offer. I at least do only one product, right? And all our energy, entire team is really focused on one product, and I'm sure that's the case with Harsh and Nalin as well. So there is a great degree of specialization and intensity that we bring to the product. Also, given that there is great discretion, chances are that people may fear that there can be dispersion of returns, right? So predictability of as you move forward is also something that some wealth managers could kind of worry about. Having said that, like I said, I think they need to look at our long track records. All of us have extremely long track records. So I tell investors, what you see in the past is what you'll see in the future. So I think that is something that needs to build over a period of time.
Yeah, so actually just taking that thought forward, I think what will help convince some of us who are looking at long shorts is, we are obviously talking about generating alpha, we're talking about protecting when the markets fall. Do we get any, so what I have seen at least in the market, and Rajesh, I think your fund is testimony of that, when markets fell last year, when COVID happened in March, markets corrected by 25 to 30% in a single month. How did your fund do differently compared to what? And obviously, people lost a lot of monies when that happened, especially in the long only portfolios, whether it was a mutual fund or a PMS. But I think some of the long short funds, what they were expected to do was to protect the downside, right? And some of the funds did very well. And I think one of the funds which did well was your fund. So Rajesh, can you talk more about that?
Sure. So basically, the entire job really of a long short fund is to protect downside. By the way, in that quarter, we made money when the entire market was down from top to bottom, actually 35 to 40%. By the way, in my 14 years of experience, and this includes 2008, we have not lost more than 2.5% in any year. That's a significant value add that you could bring to the table, right? And so you imagine the value add in, let's say, a year like 2000. Fortunately for us, the markets bounced back in 2020 quite sharply. But you imagine a year like 2008, right? Markets fell 55% that year. It was the worst year for Indian equities in 30 years, right? If you were able to protect downside, right? So what has happened to the Nifty is it's gone from 100 to 45. Now, for it to come back to 100, it requires over 100% return. By the way, long only funds were down even more in that period.
Yeah.
It took, even for the index, it took 6 years to come back to principal, which means you had mediocre returns for the entire decade. Now, you imagine the value add of a long short. If you did not lose money during that period, and you were compounding from a higher base from the next year itself. So, we believe this is an investment principle which is not very well understood. it is a necessary condition that if you want to compound at an attractive rate over the long term, you must not lose money. That's the mathematics of decline, and that's why Warren Buffett, as Nalin quoted, says rule number 1, don't lose money. Rule number 2, never forget rule number 1. So even if you look at 55 years of Berkshire Hathaway's track record, and all of us follow Berkshire Hathaway, look at the number of down years they've had. It's in probably a 2 or 3 years, the way they computed it. So in terms of book value, etc. So that is a key, and they've never had a return, I think, greater than 57 or 59%. That also took place in the 1970s. Consistency and not losing money is a key secret behind Berkshire Hathaway to compound at an attractive rate. And that's the value add that a long short product builds in.
So how does one not lose money in the current market environment? And Nalin, you want to tell us, how your portfolio is kind of structured, especially when markets have been extremely volatile and there is so much noise around, if markets could go down from these levels. I'm sure people are sitting on good levels of profits already on their portfolios. Will it help if they move to a long short fund, especially in the current market environment?
I think so, Bautik. And I want to preface this by just giving you some context of where we are today, right? So in the last 2 years of this pandemic, across industries, you've seen strong businesses get stronger, weak businesses get weaker. And that is a great canvas for a long short manager, because it means that you have half the market. Very simply, you have half the market to find winners, you have half the market to find losers. We're also in a rising rate environment, and that will bring volatility and opportunity. And I think the flexibility and freedom that a long short fund offers vis-a-vis a long only fund, in terms of not having to always be fully invested, to vary the net exposure, and also to perhaps invest different parts of the portfolio with a different time horizon. Some part of the portfolio could be short term, some part of the portfolio could be long term. This flexibility is immensely valuable, and it is going to be immensely valuable, Bautik, in calendar year 2022 and beyond. So there is a very, very compelling case at this point in time to look at this asset class.
Okay. So,
and by the way, that's resonating with customers. I mean, right? We are seeing a lot more interaction with customers, and of course, we are all seeing increases in assets thanks to that. So it's resonating with customers as well.
No, I'm sure.
Thank you, Rajesh. Yeah, absolutely.
We are seeing a lot more of that, and so I think when you're talking about customers here, all of us being long short fund managers, talk about something called risk-adjusted returns, and that's not something that you see a lot of long-only fund managers talk about. I think from a layman perspective, how does one look at risk-adjusted returns? Like because it's a slightly complicated term for a layman because they've not heard of this in the past. But if I was an investor, simply looking at investments, usually we've been taught to just look at returns or look at how much loss you had in a certain period. But from a layman perspective, what does risk-adjusted returns actually mean? And Rajesh, you want to talk about that?
Sure. So look, there are statistical metrics that people usually evaluate, look at, such as beta of the portfolio, standard deviation, which is volatility, really, Sharpe ratio, etc. But you're talking about how does a layman understand all this, right? So my pitch to investors really is commonsensical, right? If I'm not going to lose money for you and I'm going to give you equity returns, what more do you want, given the environment that we are in, right? So that's the product. If you don't lose too much money and make equity type returns, that's how you should understand it. As simple as that. And I just want to add, I think this ability to short is probably an underappreciated phenomenon. Now, long only funds can't short, but I think this is one of the best environments to have a short book, and I'll tell you why. Apart from cycles becoming shorter, right? Inflation diluting profitability of several companies, and that's what we are seeing today. This is an age of disruption, right? And basically, some people would say this is a time when businesses are seeing the largest disruption ever, right, to their economics. And so what we are seeing also is derating of businesses. So the way you value businesses is you take the net present value of free cash flow to equity, right? And the later on free cash flows matters a lot to the net present value, right? So even though some businesses are still generating free cash flow, the markets are realizing that these free cash flows later on is going to get disrupted, and therefore you're seeing price earnings come off. Look at broadcasting networks. They used to be 30p, 35p. They've all come down to 15p. Look at automobiles. The threat of electric vehicles is derating some of these companies. We'll have to see how financials move. You'll have to see how organized retailing moves. But there are so many disruptions that are taking place that I think it's a great time to have short book and add value as a fundamental analyst.
Yeah, so basically what you're saying is, that's a good way of putting it, that, people should just not think about the Greeks that are thrown to them, alpha, beta, gamma, sharps, or Tino, and instead look at it in a very simple way of how to not lose money, right?
Yeah.
So that again brings me to the next point, which is people have been investing in mutual funds for the last more than 25 to 30 years, right? And pretty much now that we see the amount of SIP book in the industry, I think it is more like a household phenomenon for people to invest in mutual funds or even PMS products for that matter, right? How does an investor kind of differentiate in his portfolio, right, compared to a mutual fund to invest in a long short fund? What does he need to think about? Like, where does he place some of these long short funds in his portfolio? Because I, as an investor, I'm used to investing in mutual funds. I have fixed income products, I have equity products. Where do I place these long short funds, right? And how do I differentiate among them? Harsh, you want to talk about that?
Sure. Like you said, Bhautik, you are a mutual fund investor. So, you would have a lot of offerings with the mutual funds, both on the fixed income side and on the equity side. Now, every fund, whether it is a long only fund or a long short fund, especially if it is on the equity side, it has two major components. One is the sensitivity to the market. If the market is going up 10%, how much is this product gonna go up by? Or if the market is gonna fall by 10%, then how much is this product gonna fall by? So this is called as sensitivity. And the second is the absolute and alpha part. So the active fund managers are supposed to make some kind of alpha over the benchmark. So let's say on a scale of 0 to 100, where 0 represents your zero equity risk, it could be your arbitrage funds or your fixed income, and 100% represents, let's say, your Nifty or large cap funds. So you will have this scale where you could place your mutual fund offerings. So primarily your fixed incomes will come on the 0 scale. Your next higher risk is the equity savings product, which is 35% cash equities and then balances in fixed income. So it has a pointer at, let's say, 35%. Then comes your balance advantage fund, which are generally about 50% invested in equities and then balances in fixed income. And then you have aggressive hybrids, and then you have large caps. So on this scale, when you're looking at long short funds, I think the first and the most important thing is to try and place each long short fund on this scale. So it could be positioned as fixed income, so it will be on the 0 part. It could be on the aggressive hybrid part, so it could be about 75% cash equities or net equity exposure, or it could be constructed on the balance advantage fund or equity saving side. So the most important aspect I feel is that for the investors to look at where would they place each long short fund at, and that will decide what their need is, whether that kind of sensitivity or equity risk, whether it suits them or not, whether it is aligned with their existing portfolio and their goals. And the second is to look at the alpha and absolute part. Beyond this sensitivity, how much this fund is making for me. So a simple question could be, if you have to negate this sensitivity totally, so assume that markets remain flattish for next 3 years, 4 years. So how much returns will your mutual funds or long short funds make? If you try and answer this question, or try to figure out an answer for this question, you will understand the merit of each product. See, as an investor, while the markets are structurally uptrending, you don't want to rely too much on the beta part, which is, rely too much on this market dependence. So here your alpha part comes into picture. Beyond this sensitivity, am I going to make money from this fund or not? This is something that you have to really understand and determine for each long short funds. And it is also possible, Bautik, that there could be some long short funds which are nowhere in 0 to 100 scale. They are completely uncorrelated to any of these equity investments. That would actually be even better, because if you invest in those kind of funds, then you're truly achieving diversification, and you're really cutting down your overall portfolio risks. Having said that, most of the long short funds will be placed on 0 to 100 scale. There will be few funds who might be somewhere off, but those are really niche funds, and those are obviously your good diversification bets. But even the funds which are placed on the 0 to 100 scale with some kind of net equity exposure, they must be delivering you an alpha. So let's say if you like balanced advantage fund, you should look at, is there something in the long short space which is similar to a balanced advantage fund construct, but it can give me, let's say, 8-10% more than balanced advantage fund. So you will be able to find something that is already there. So this is what I think the long short funds really bring on. They bring that superiority, superior returns relative to mutual funds on a similar risk basis. So in fact, to your previous question on, what is the meaning of risk adjusted basis, I tend to look at risk adjusted returns on this scale. Where is my risk lying? And if the returns are commensurate with that risk, or they are exceptionally high, I would simply go for that product. So I think that's the right way to analyze long short funds, and also to compare them with mutual funds.
I think that's really interesting. I think.
Can I add something there? I mean, what I want to add is that, I think what is underappreciated is the world that we are in, right? And the laws of finance and economics have been disrupted. Past cycles are not reflective of what is to come, because of what I would call artificially engineered markets. Now, as an investor, you're looking to make a attractive return, given that fixed income is not making you a return, and you're looking ahead into this environment, right? The artificially engineered environment. Now you want some sort of an insurance that I'm not going to lose too much money. As Seth Klarman said recently, 30 years of compounding can get disrupted with one bad year, right? You lose 50% in 1 year, your CAGR for 30 years goes down by half, right? So it's important that as you move forward into this environment, you want a bit of an insurance to your equity strategy. I think that's also a position that a long short equity fund finds itself in.
That's interesting. So basically bring in the diversification to your long only portfolio, which will give you some kind of a hedge to what you have otherwise in the portfolio. So that, I'm sure investors want to discuss a lot more of long short funds. But just one last thing which does play on, most of us investors' mind is when we're investing in long short funds compared to what we've been doing in mutual funds or PMSs is taxation, right? And Nalin, you and me especially have been in a lot of forums, discussions around taxation. We've also visited some of those offices in Delhi to talk about that. But so what's your sense? Is taxation really an issue that investors should be focusing on when they're investing in long short funds?
Bautik, you and I have spent, I think, countless evenings working on this. And there's a lot of work left to do.
Yeah.
I want to just share two. The first is that, unlike a mutual fund, where an investor pays tax when they redeem, in a category 3 AIF, taxation is at the fund level. And that means that it's incumbent on the fund manager to not only manage the portfolio, but also have one careful eye on taxation. And it's very, very intrinsically linked to how you manage the portfolio. So that's the first big takeaway, and it is an important part of any investors or any distributor's due diligence. The second thing, Bautik, is, in the 2018 budget, there was a surcharge on derivatives that was introduced. And there was a lot of media and hype that this was the end of the category 3 industry. But here are some statistics that I want to share with you. In the 3.5 years that have passed, the industry has grown from about 15,500 crores to 56,000 crores. It's grown 3.7x in 3.5 years. And there have been 76 new entrants who have come in subsequent to that tax increase. So I think if you solve an investor's problem, there will always be money for a fund manager, regardless of tax or not. And I really hope that we do get pass-through taxation at some point in the future. So many more evenings to be spent on this, Bautik.
Thanks. Yes. I think we will do that. And, that just brings me to the end of this discussion today. And I just want to leave the investors with, the final thought that we got from the discussion with Nalin, Rajesh, and Harsh, is that we've all been taught to look at returns, part of compounding, and that's how we can create wealth over the long term. I hope that we start looking at the other side, which is how to not lose money, and how will that actually help compounding over a period of time, and how will that actually help create better wealth in our portfolios. So thank you so much. Thanks, Rajesh. Thanks, Harsh. Thank you, Nalin, so much for joining us today. And I hope our investors have got some meaningful thoughts out of this discussion. Thank you.